joining us from.
Well, thank you very much, and good evening, everyone. Thank you for coming along today. So, as Robert said, we're going to be talking a bit about the St James's Place approach, a bit on markets, a bit on the macroeconomic update. Quite a lot to cover off there. I've got the Q&A box open, ready for any questions as you come in. So, starting with a St James's Place update, I just want to talk to you a bit about our approach and why responsible investing is so important to us at St James's Place. So firstly, our approach to investment management. What I'm showing you here, these are the fund managers that we work with from all across the world. We take a global approach to selecting fund managers. So what you can see here, we select them from everywhere. And you can see, hopefully you can see some red lines, hopefully coming from various fund managers into where they're from. Those red lines indicate fund managers who are exclusive to St James's Place clients. So if you were invested elsewhere, you would not be able to access these strategies. So that's one thing that I think sets St James's Place apart, is that we can work with these managers, negotiate fees with them, and provide you exclusive access to these fund managers. So I'll just give you one example just to bring that to life a little bit here. You see, by New York, we've got KKR just there. KKR manage our diversified assets fund, which I think some of you on the call perhaps may be invested in. This fund provides access to private equity, private debt, infrastructure assets, which is a really interesting asset class, and not one which you could just readily invest in if you go down to Hargreaves Lansdown or wherever else and invest in private equity. It's much more challenging. But at St James's Place, we can provide access to those types of fund managers. At St James's Place, responsible investing is core to what we do. So just to get us all on the same page, when I'm talking about responsible investing, what do I mean here? Responsible investing is the incorporation of environmental, social, and governance factors into the investment process. So it's a little bit different to ethical investing, which is much more subjective to you, the client, where you might decide that I don't want to invest in oil or gas companies. A little bit subjective, whereas responsible investing is incorporation of the environmental, social, and governance factors. Now, you may have heard a lot about responsible investing over the past couple of months. I think probably with COP26 in particular, there's been a lot of attention, a lot of noise around that. But at St James's Place, we've had a responsible investing journey that's, I think we're about 7 years into now, started back in 2014, where we started looking at all of our fund managers and assessing how they incorporated ESG, environmental, social, governance factors into their investment process. So the good news is that if you are invested with Stringer Mann here, we already know that you've got a responsible investment portfolio. If you're there thinking, oh, that sounds interesting, I care about my sustainable lifestyle, I care about COP26. Well, actually, it's already at the heart of your portfolio. And we've made a lot of progress in the last 7 years. So, for example, we've signed up to the Net Zero Asset Owners Alliance, which you can see here in the green towards the right of the screen. What that means is that by 2050, all St James's Place investments will have a net zero carbon footprint. Now, you might be thinking 2050, oh, that's quite a long time away, isn't it? Well, I can tell you it's actually pretty punchy. We've actually very recently, this is very recent news, set ourselves a carbon footprint target for 2025 to have reduced our carbon footprint of all St James's Place investments by 25% by 2025. And I'll talk to you a little bit about how we're going to do that and some of the steps that we're taking there in a second. But that's quite exciting for us. Last year, we got to 100% of our fund managers signed up to the United Nations Principles of Responsible Investing. So this is a global responsible investment standard. What it means is that every one of our fund managers is committed to investing your assets responsibly. So they're thinking about the environmental impact that a company might have. So what is that company's waste management policy? What do they think about climate change? How efficient are their buildings? There are a lot of factors there that they're looking at Oh, has this company had any huge human right breaches? Bit of a disaster there. How do they treat their employees? What's their tax strategy? Is the CEO and chairperson, are they separate? So looking at those environmental, social, governance factors is deeply integrated across the whole proposition. And a very recent step that we took, see it right on the right of the screen, Robeco appointed as our engagement partner. So at St James's Place, we are active owners of the investment. So you entrust St James's Place, you entrust Stringer Mann with your investments. We want to make sure that your money is used as a force for good. So how do we do that? Well, the fund managers who manage your money and Robeco as our engagement partners actively engage with the companies that they are investing in, that you are invested in, and encourage them to improve. So it's about identifying an issue in a company and working with that management team, working with them to improve, because what we see is a lot of the companies, they do want to improve. They care about their carbon footprint. They care about their social standards. They just might need a little bit of help getting to where we need to go. So Robeco will engage with these companies on behalf of St James's Place. And actually very recently, we have released our first engagement report. So if you're interested in reading that, I would recommend. That's something that we can provide to you after this session today. You might be thinking, engagement, okay, that sounds great, but that sounds like a really long process. It is a long process, but we are firm believers that in continuing to engage with companies, continuing to encourage them to improve, is a much better way of getting them to change rather than just divesting. So, we could just sell out of oil and gas companies, for example, or sell out of tobacco companies. But then actually somebody else will buy those shares. Will that next investor be as focused on driving sustainable positive change? Perhaps not. Perhaps, but perhaps not. So we really do believe that continuing to engage with companies, forcing them to improve, pushing them to improve is what we want to do. That's how we'll make the change. So hopefully you can see there a bit of an overview of responsible investing and how we're thinking about it at St James's Place. Hopefully you can see there that it is very much at the heart of what we're doing. And your investment portfolio, you can hopefully go away reassured that responsible investing is integrated throughout. I mentioned the carbon footprint target, and I talk a little bit about how we're going to get there. So those of you who are invested in the Global Equity Fund, you would have had a letter coming through your door in the last few weeks telling you about the changes that we're making. So the Global Equity Fund is one that we've been monitoring. We've been monitoring all of our funds kind of as an ongoing basis, but one that we've decided to change. Global equity, we're changing it to be a low carbon strategy. So it's going to be still invested in global equities, as the name would probably suggest, but with a very strong focus on low carbon. Now, this is a big step in how we're going to meet that 25% reduction target that we've got in the next few years. At St James's Place, I showed you that world map earlier. We appoint fund managers from around the world who we believe are best in breed fund managers, the best people to manage your money to help you meet your objectives. These are St James's Place funds, though. So the fund manager doesn't own the fund, they are an advisor on the fund. So they advise on the fund, but because St James's Place own the funds, what that means is we can change the fund manager if we believe that they are no longer the right manager to meet your objectives, no longer the right fund manager to run your money. We monitor these fund managers on an ongoing basis. So we'll have several calls with them every month from the investment team, from our investment committee, with the external consultants that we work with. We're all monitoring these fund managers, making sure that they're doing their jobs. However, if they stop or if we want to change the fund, we can do that. So that's what we're doing here exactly. We're changing the fund managers, adjusting the focus of this fund and making it into a low carbon strategy. Now, I'm pleased to say that the Global Equity Fund, we are midway through that transition. It will be our low carbon strategy by Christmas. So a little bit of good news for you there. I'll give you another example of the approach that we take, the selection of the managers, the monitoring them, and the changing where it makes sense. Those of you who are invested in any of these three funds, the UK Absolute Return, Alternative Assets, or Multi-Asset, you would have also have got a letter through your door quite recently telling you about the changes coming to these funds. So in January, these three funds are going to be merged. We are working to improve the proposition, streamline our proposition where it makes sense. So we've been thinking about what do we want the fund range to look like in the next few years, and putting together a bit of a plan to get us to that point. So in January, these three funds will be merged. So if you do hold any of these strategies, that is going to be coming in the next couple of months. The point that I want you to be aware of here is that your money, though we appoint these external fund managers to advise on those funds, St. James's Place do keep a really close eye on the fund managers, what they're advising, making sure that they do continue to be suitable to manage your money. And if not, then we will take those actions and we will make those changes. So that's the job of the investment team. That's what we're here for. So that's a little bit of information on the changes that are coming up there. Now, I just want to talk now a bit about markets and the macroeconomic environment. We've had a question on inflation, which I will address when we get to that point. But if anyone has any other questions, I don't think I've had any other questions in about the St. James's Place approach, but please do drop them into the Q&A if you have any. So firstly, I wanted to talk about equity markets, what's been going on in equity markets. So what I'm showing you here, we've got 4 global equity markets. We've got the US, the S&P 500 in the orange. This is A at the top. We've got the FTSE 100, the UK market in the red, B here, Europe in the green, C, and emerging markets, which is a lot of the Asia Pacific region in blue, the D there. So this is performance that we've seen from these markets this year. Now, I think perhaps what stands out most is the strong performance that we've seen from the US. So you can see there in the orange, the US market has been one of the strongest performing equity markets that we've seen this year. And the US has been a very strong performer for the last few years. A lot of this strong US performance has been driven by the big technology companies. So the Amazon, Alphabet, Apple type companies, those enormous technology companies. And we've seen that this year, that those companies have continued to be really strong performers. The UK in the red has lagged the US a little bit this year, as you can see there. The UK has been quite an interesting place, I think, this year. Earlier in the year, we saw more strength from industrials, from financials. But actually later this year, that has maybe dropped off a little bit. What we've seen in Europe has been very much split between various countries. So, for example, in the summer, we saw countries such as Italy, Spain, those kind of countries where you probably want to go on holiday, big tourism, they've attracted a lot of tourists there. Those kind of countries did really well. However, the more manufacturing focused countries lagged a little bit, but you can see the European performance has been fairly strong in comparison to emerging markets in the blue, which I think you can see there that emerging markets have struggled. Now, this has largely been led by the Chinese stock market. The Chinese stock market has been extremely volatile this year. And we've seen regulatory crackdowns on companies such as Tencent, on the education sector, and more recently, Evergrande, the property developer, concerns around, are they going to default on their debt payments? What's going to happen there? Will the Chinese government support them? So it has been a really volatile place in China. And we've seen strength from other emerging market countries, such as India, for example, has been a strong performer, but the Chinese market has been quite volatile. I think if we focus just in on the last couple of weeks, it has been a volatile time in markets with all of the news from around the new variant and, oh dear, what does this mean? Markets are driven by uncertainty. Markets will move when there's something uncertain going on, if there's something completely unexpected, that will be what moves markets, rather than something that's expected. Markets don't really react when they know something is going to happen. It's kind of already in the price. So I think that's what we've seen in the last couple of weeks. We've seen a lot of uncertainty in the market because it seems like nobody really knows what's going on with this new variant. How dangerous is it going to be? It seems like it's very contagious. Who knows? I think there's a lot of uncertainty there. We've just had a question. Thank you for that one. Do you think this volatility is here to stay for the short term at least? I think, well, what I would say on that is, whilst there is uncertainty around this new variant, I would probably expect there to be a volatile time. I think until we have a little bit more of an idea around where do we actually stand with this new variant, then I think markets could be quite volatile. But what I would say on that, from a market perspective, it's not necessarily a bad thing. It's perhaps not the best thing if you are invested in passive investments. You've got a S&P 500 tracker, because that fund isn't going to react to what's going on in the market. However, volatility is a friend of the fund manager. With volatility comes opportunity. So what we would expect, and what we saw, for example, in the early part of the pandemic last year, is our fund managers would react to market conditions. They would take advantage of shorter term opportunities in the market. So perhaps one company the share price had fallen. They'd take that opportunity and buy it if that was a company that they wanted to be invested in. So I do think that until we've got a little bit more clarity with where we stand with this new variant, then that perhaps we are in for a period of volatility. But what I would say is, perhaps don't worry about that. If you are invested for the long term, short-term volatility is not something to be too concerned about, especially if you do hold a well-diversified portfolio that is not just invested in passives. Active managers can react to the short-term volatility and take advantage of those opportunities. And just on that diversification point, what I would say here is, look, we can see the divergence in different equity markets. It's so important to maintain a well-diversified portfolio, because year on year, we can't be sure which equity market, which asset class is going to perform the best. So last year, for example, China was a really strong performer. This year, it hasn't been. It's important to hold both China, other asset classes, ensure that you may remain diversified. Thank you for that question, though. Just on that diversification point, and I've touched a little bit on passives. What I'm showing you here, so we're back on the US, the S&P 500, the US market. What I'm showing you here is how concentrated the US stock market is. So the S&P 500 major stock market index in the US. This is year on year, how much the 5 largest companies make up of the index. So you can see now where we are today. The top 5 companies, the big technology companies, make up about 23% of the US market. So it's really concentrated, more concentrated than we've seen it probably ever. I mean, if we look back in the early 2000s, where we had the dot-com bubble, the big technology bubble, even then the market wasn't as concentrated. So what I would say there is, again, on investing passively, you will have a lot of risk in that big technology basket. Please do make sure that you do maintain a well-diversified portfolio rather than just investing in passives, because what happens if there is tech bubble too? I'm not predicting that, just to be clear here, but you've got 23% of your assets in that one area. Perhaps a little bit concerning. So what I would say on that, make sure that you do retain a well-diversified portfolio.
Sophie, why is it the US always seems to push, or we follow the US market? So whenever we look at the market, what do we think is going to happen in the day? So today was COVID's causing the issue, or we're waiting for results on something in America. So why are we so affected by America and the UK?
Yeah, I think that's an interesting question. So what I would say that the reason for that is, so the US is one of the largest markets, right? If we look at a global equity index, it makes up around 60%. So what we would see is investors in the US will also hold investors around the world And the reason why they are so closely linked, firstly, a lot of international companies, but actually sentiment. So if we start seeing things starting getting concerned about something going on in the US, that sentiment, how investors are feeling, is a really strong driver of markets. So if markets start to make people concerned in the US, they're going to be concerned, and they're going to be concerned about their investments across the world. So that's kind of it. The US is such a big market, but it kind of, the sentiment really drives that.
Okay, thanks.
Okay. I want to talk about inflation. I know we've had a lot of questions about inflation. So what I'm showing you here, this is UK inflation, latest UK inflation reading. We had this quite recently. In November, UK CPI got up to 4.2%. So, and we're talking about a higher level of inflation than we have been used to, but not ridiculous levels of inflation. We're not talking about any kind of hyperinflation here. So you can see from the chart that I'm showing you that what Pantheon Macroeconomics, they are a research provider that we work very closely with. What they're predicting is that next year, in the next couple of years, we will see inflation get up to over 5%. That's what the Bank of England are expecting. We would expect that in that case, interest rates will be increased. That probably wouldn't be entirely unlikely in the next few months to bring inflation under control. So firstly, what's driving inflation? There are a few bits going on here. So we did have a question earlier about supply chains and how will inflation tolerate that? I think that's a really interesting point. So the supply and demand factor absolutely is something that does drive inflation. So I suppose from higher demand comes inflation. We've also seen a lot of stimulus being pumped into various economies over the last couple of years in response to the pandemic. So fiscal easing, monetary easing, interest rates being cut everywhere, all with the aim of stimulating production. That's inflationary. We've also got employment rates really, really high, especially in the US, for example. Again, that's inflationary. But what I would say on this, so if inflation does get up to about 5%, first point which you might want to consider, if you are holding a lot of cash, the value of that cash is being eroded at a 5% per year in kind of real purchasing power. For me, that's quite uncomfortable. Perhaps have a think about if that's something that's comfortable for you or not. The other thing that I would say on this is that, as you can see, we do expect that inflation, it will increase, but we'll come back to the long-term target of around 2%. I think a bit of good news here is with interest rates at all-time lows, there's plenty of room. The Bank of England, other central banks have plenty of room to increase interest rates. It will likely be a gradual thing. We don't expect to suddenly wake up tomorrow and the Bank of England will have said our interest rates are at 10%. It will likely be much more gradual than that, but they've got a lot of space to start increasing interest rates to keep inflation under control. So we would expect that in the next couple of years, inflation will be around the long-term 2% target. On inflation, just sticking with inflation, it's been a really big driver of fixed income or bond markets this year. So what I'm showing you here, this is a government bond index. And you can see in the white here, it's been a bit of a tricky time for bond investments for fixed income. What we've seen is that increased inflation expectations have meant that interest rate expectations have increased. What that has done is push down the prices of bonds. Now, this is kind of what we've seen globally. What I would say on that, again, I know I've mentioned it before, but make sure you've got a well-diversified portfolio, because inflation will affect different sectors, affect different regions, affect different credit ratings differently. So diversification here is key. But with inflation, fixed income can be a little bit of a difficult place to be. But to borrow one of my colleagues' lines, what he always says about this when we say, oh, well, why hold bonds in this period? Well, when you woke up this morning, I'm sure you didn't cancel your contents insurance or your home insurance when you realized that your house wasn't on fire this morning. So that's why we hold bonds. That's why we would continue to hold fixed income, to hold bonds as part of a long-term investment strategy. Now, remember what we were just talking about. Inflation might be higher for a year or two, but then dropping back around the long-term target. If you are invested for the long term, then I don't think that's something that you should be too concerned about. Again, it's the short-term volatility, but actually you've got your long-term target, maintain a diversified portfolio. And then that short-term noise is just noise. So that's what we're seeing in fixed income markets. And just a point on that, what I would say is fixed income, maybe it has been a difficult place this year, but there have been opportunities in other asset classes. So property, for example, a lot of rent is adjusted in line with inflation. So with increased inflation, increased rent. So a little bit of protection there, perhaps. Okay, I think that's everything that I wanted to go through with you today, but we've got time for questions if anybody has anything that they would like to discuss.
Thanks. Sophie, what about commercial property then? It's had a pretty tough time, and particularly during COVID, because the surveyors couldn't get out, so some property funds were closed. But we've got lots of clients that invest within our funds, but also in their own buy-to-lets or own commercial property. So how do you see those going based on what you just said?
So I think that's interesting. And what I would say is it probably very much depends on the sector that you're invested in. So I don't know about you, but over the last couple of years, I've been ordering a lot more off Amazon. So that kind of demand for warehouses in particular has absolutely shot up over the last couple of years. And I'm probably not alone in saying that or admitting that. So I think depending on the sector, there are kind of pros and cons. What I would say is sectors such as warehouses, industrial spaces, out of town retail perhaps have been really defensive so far and perhaps looking more positive. I think high street retail is maybe a bit of a difficult place to be. I think we're hearing more and more news about various places closing, aren't we?
Yeah.
So I think got to be very careful about the type of property that you're investing in. I think offices is an interesting one. It seems like for the kind of higher end commercial property offices, perhaps in London, in big cities, that demand still seems to be there because people want to go back to the office, right? They don't want to be working from home forever. Well, that's what we're seeing. So we aren't really seeing the demand there drying up. What I would also say on that is a lot of the leases are long term. So it's not necessarily that a company wants to sell out and they do it next week. It's okay, they're tied into that lease for the next 5 years. So there's a bit of protection there too.
Wonderful, thank you. You've got a question there about inflation.
Is inflation always a bad thing, or can it have positive effects? That's interesting. Okay, so can inflation have positive effects? So I think, yes, it can do. I think what's important here is to invest in companies, if you are investing kind of in equities, to invest in companies that can pass those costs onto the consumer. So with inflation and perhaps they're having to pay more for the materials, if it's a manufacturing company, if they can pass that cost onto consumer, then it's not going to be eating into their profits. If it is a company that perhaps has really tight pricing power, can't pass that cost on, then I think that maybe is quite dangerous for that company's bottom line. But no, I don't think inflation necessarily is always bad. In the central banks target a small amount of inflation, around 2% a year. If it gets really high, hyperinflation, then that's definitely not a good place that anybody wants to be in. If it gets to deflation, not a place that we want to be in either. But I think a small level of inflation, especially if you can pass those costs on to the consumer, not necessarily a bad thing.
Yeah, I mean, it's not always positive for markets, although sometimes I always think it causes a little bit more action. But with the rule of 72, it erodes the value of debt as well, doesn't it? So there is that, which we haven't had for a period of time, which is why your mortgages seems to stay at a fairly sort of at a level where in the old days it used to go down. And I love the rule of 72 because you can use it both ways, can't you? Both on inflation and growth. But there you go. Yeah, I think it is what we are, I suppose we're all worried about that when we hear the news, and that affects sentiment and things, isn't it? Richard, you've raised your hand.
I haven't.
That's cool. That's really technology. Well done.
Yeah, just with regards to this new variant, obviously we saw a huge reaction in the markets on Friday, came back up again on Monday, down again on Tuesday, back up again on Wednesday. What is there a view on? Have they already priced it in now? Do they feel the impact isn't going to be as significant as they first thought, or is it just as news comes out? Because obviously, I know things like Biden saying, "Look, we're not going to shut down. We're just going to manage this." Those sort of things obviously improve the sentiment in markets. Or do you think there's more to come out here?
Well, I think that's a really, really big question, isn't it? I think. I mean, as news comes out, markets are reacting to that. That's what we're seeing, that we're seeing a lot of volatility. I think what I would say is there still is a lot of uncertainty. I mean, it might be saying that things aren't going to shut down, and really fingers crossed that isn't the case. But I don't think we really understand the extent of perhaps how dangerous this new variant could be. I mean, what if that does happen? I think markets would absolutely react on that. I think to an extent, I think you're probably right that it is baked into the price, but I think there's probably also a little bit of jitters, a little bit of uncertainty there still.
Yeah, because to obviously go up 100 points again today, what's driving it suddenly to go up 100 points again?
Yeah, it's all over the place at the moment, isn't it?
Yeah. Okay.
Yeah.
So it's not them feeling that, okay, perhaps the impact on the larger companies isn't going to be significant, especially obviously again with the US being where it is.
Yeah, and I think there's a lot going on at the moment, isn't there? So the variant is driving markets uncertainty there. We're also concerned about inflation and what's going on there, supply chain issues. I think sometimes it's really hard to isolate what it is, that one factor that's driving markets at the moment. Well, I would agree that especially in recent weeks, we have seen a lot of volatility coming through from this new variant, but who knows? Hopefully, I guess we've just got to keep an eye on it and see how it develops.
Yeah, I think, as we always say, the lesson is diversification, and then making sure that people, clients are investing money for the medium to long term, and that so therefore part of our job in March 2020 was to be able to be with clients and to hear the uncomfortable nature of what's going on, and to say, unless you need your money out, stay in there, and this will all be eventually will be a blip. Obviously it's gone on a bit longer than we thought, but it will be a blip on that graph, like 2008, like 1987. So it is always a matter of knowing that clients' money is invested for the right time and diversified, and therefore ignore this daily news, but it's very difficult because we're all humans, and we're all listening to that every day and affected.
Yeah, as much as you say, the common denominator is we always come out of these things. People say, yes, but it's different this time. I believe it's always different, which is why markets react like they do. But so it's just keeping our nerve effectively, making sure, like Sophie says, we diversify, got enough cash to cover our short-term needs, and why we've invested is still the same today as it was yesterday. So as long as we keep an eye on what our goals and aspirations are, then we have to sit through these things.
Yeah, I think that's true, and I think certainly, as I keep saying, we're in a better position than we were, even though we've got this new variant, and hopefully then the boffins will sort that out, and they'll solve that, and they'll get everything done. But having looked at the Spanish flu, the waves, they had 3 or 4 waves. The thing went on for 3 to 4 years, and they've gone through a war and carried on. So over time we have had these. We've had various things that have gone for a while, and I think we just, looking at that chart that we have, which is that eventually we'll look back and think, gosh, did we really go through that? But the main thing is we have to hold our nerve, and we have to keep going. I think that's always the important thought here, really.
Yeah, about remembering your objectives, remembering your time horizon, and not panicking if there's a little bit of short-term volatility.
Absolutely. I'm going to throw in another one here. Have you got any? This completely just came into my head. What's your opinion on cryptocurrency? And what's our opinion on cryptocurrency?
Oh, that's very interesting. Okay, so I think on cryptocurrency, just to be clear, we're not going to be launching an SJP cryptocurrency fund or anything like that. That's not on the cards. I think if we look at the volatility of Bitcoin, for example, it's just ridiculous, isn't it? It's such a high risk asset. Who knows which way it's going to go? And I think for a lot of investors, that amount of volatility is quite uncomfortable. If you have an investment portfolio and it's not 100% equities, then it's probably not an asset class which that level of volatility would be comfortable for you, perhaps. Now, what I would say, and I think maybe it's a lovely comparison, that we're not necessarily against you going down to the races and putting a bit of beer money on the horse and hoping for the best. Investing in cryptocurrency is maybe a little bit like that. It's beer money, not pension money, because it is just so volatile, isn't it?
It is funny because we have clients now, so many clients asking about ESG and really serious, and we have that. And then I have clients going, "Oh, what's your view on cryptocurrency?" We really don't. We're not involved in that. It's not something. It's not regulated. It's not our thing. But they go, "What do you think?" I go, and that's the answer. It's like horses.
Yeah, it's interesting, isn't it?
Yeah, it always makes for a great conversation, an interesting conversation towards the end with the client.
Yeah.
Good. I think if there's no more questions coming in, has anybody? Yeah, just obviously we're due for a couple more minutes to go on. Has anybody more? Oh, here we go. Have you seen that one?
Yes. With Tesla being so large, not only leading the way with electric vehicles, but the US stock market, how do you diversify by investing in the future technologies?
Wow.
Okay, that's interesting. Investing in future technologies. So what I would suggest there, if you want to invest in future technologies, typically what we would see is something like a really high growth type strategy. So for example, St. James's Place, the Global Growth Fund, is quite technology focused and very much focused on that kind of growth area. And within that, I mean, companies like Tesla absolutely have their place. And I think we can look a little bit further than Tesla. I mean, if we look into emerging markets, for example, there are companies there such as Silergy Laser Tech who are kind of developing those batteries, the semiconductor kind of supply, where I think it probably is future technologies there too, which is very interesting. But I think it's important to not be so focused on, okay, what do you hear on the news? Oh, Elon Musk has tweeted something. Tesla is the only way to go, because there are so many different companies kind of outside of that who are kind of very growth focused, very future technology focused. If you don't want to be researching all of that, then I would say have a look at a growth type strategy, and that will hopefully give you the diversification that you need there.
Yeah, incredible. Good. Any more questions coming in? No. Excellent. Well, I just want to say, Sophie, thank you so much for your time and putting through that presentation and taking us through that. It's wonderful. You've covered all the points that clients have asked us, and which is fantastic. Thank you so much for that. And thank all of our clients that are here now, some that were unable to join us, and also this will be shared, people will be able to watch it again. But thank you, every single one of you, for attending, because it means so much to us, and you have the opportunity to have Sophie imparting her fantastic knowledge. But yeah, and that's great. Thank you, Richard. I was on mute.
Yes. Yeah, thank you very much, everyone. It's good to see you, and thank you, Sophie. That's really useful.
Thank you.
Thank you.
Thank you very much. Have a good evening, everybody. And any questions, come back to us, and we'll see you very soon. Thank you.
Thank you.